Hey everyone, Bella here. Welcome back to Blue Spear TV, where we break down personal finance and self-improvement strategies to help you take control of your financial future. Today, we're doing a deep dive into a powerful investing strategy known as the core satellite investment approach. If you're someone who wants to build long-term wealth with lower risk, but still want some room for high growth opportunities, this is the strategy you need to know about. So stick around as we explore how this balanced approach can help you maximize your returns and minimize your risks. Let's get started. Let's start with the basics. The core satellite strategy is an investing approach that's perfect for beginners and seasoned investors. It combines stable long-term investments with more aggressive, high-growth opportunities. In short, you're building a portfolio that consists of two parts. Number one, the core. This is the foundation of your portfolio. It typically includes low-cost, diversified, stable investments, often in the form of index funds and ETFs, exchange-traded funds. The goal of the core is to provide consistent long-term growth with minimal risk. Think of it as the reliable backbone of your portfolio that helps you stay on track towards your long-term financial goals. Number two, the satellites. These are the more flexible and aggressive investments that orbit around your core. They allow you to seek higher returns by investing in individual stocks, sectors, or other more volatile assets. The idea is that while these investments might have higher risks, they have the potential for higher returns too. The satellite portion allows you to take advantage of short-term opportunities without exposing your entire portfolio to unnecessary risk. By blending these two elements, the core satellite approach gives you the best of both worlds, long-term stability with opportunities for short-term growth. So why should you consider this approach? Let's break it down into a few key benefits. Number one, diversification with stability. The core of your portfolio focuses on broad diversification, which helps lower your risk. Diversification means spreading your investments across different asset classes, industries, or geographies to reduce the risk of any single investment tanking your portfolio. When you hold broad index funds or ETFs in your core, you're essentially investing in hundreds or thousands of companies at once, which provides stability. Number two, flexibility and growth. The satellite portion helps you seize high growth opportunities. If you've ever wanted to invest in emerging industries, tech stocks, or any high growth asset, satellites give you that flexibility. However, since these investments make up a smaller portion of your portfolio, your overall risk remains relatively low. Number three, cost effectiveness. Using low-cost index funds as your core ensures you're not losing out to high fees. Many managed funds or individual stock picks come with hefty costs that eat into your returns. The core satellite approach minimizes these fees by focusing on cost-effective investments in your core. Number four, personalization. One of the best things about this strategy is how customizable it is. You can adjust the size of your core and satellite positions based on your risk tolerance, financial goals, and investment horizon. If you're more conservative, your portfolio can be 80% core and 20% satellite. If you're a bit more aggressive, you might go with a 70-30 or 60-40 split. So how do you go about constructing this portfolio? Here's a step-by-step breakdown. Step one, build your core 70 to 90%. Your core should be the largest portion of your portfolio, anywhere from 70% to 90%, depending on your risk tolerance. The goal here is long-term, stable growth, and the best way to achieve that is through diversified, low-cost investments. Some great options for the core include total market index funds. These funds give you exposure to the entire stock market, often covering large-cap, mid-cap, and small-cap stocks. S&P 500 index funds. These funds track the top 500 companies in the US, providing you with solid exposure to the leading businesses. Bond funds. If you want to reduce volatility further, consider adding bond funds to your core. Bonds tend to be less volatile than stocks and add some much-needed stability. The key here is to keep your investments simple, broad, and low cost. Step 2. Add your satellites 10% to 30%. Next, it's time to spice things up with satellite investments. Satellites make up a smaller portion of your portfolio, typically 10% to 30%. These investments can be more speculative or focused on high growth areas. Some examples of satellite investments include individual stocks. If you have specific companies that you believe in, you can allocate part of your satellite portfolio to these stocks. Sector ETFs. Want to invest in specific sectors like technology, clean energy, and healthcare? Sector ETFs gives you exposure to these industries. Emerging markets. Investing in fast-growing economies like China, India, and Brazil can give you higher growth potential, but also higher risk. Alternative investments. If you're a bit more adventurous, you can even add cryptocurrencies, real estate investment trusts, or other alternatives to your satellites. Just remember, whilst these satellites can give you great growth opportunities, they're also riskier than your core. Keep them as a smaller percentage of your overall portfolio. Step 3. Rebalance regularly. Once your core satellite portfolio is set up, you'll need to check on it periodically to make sure it stays aligned with your goals. If your satellite investments perform well and grow too large, your portfolio might become too risky. If your core outperforms, it might be too conservative. Rebalancing once or twice a year ensures your portfolio stays in line with your risk tolerance and long-term goals. Let's break it down with an example. Let's say you're a moderate risk investor with $100,000 to invest. You might allocate your portfolio like this. In this setup, the core provides stable growth whilst the satellite gives you potential for higher returns. The core satellite approach offers the perfect blend of stability and flexibility. With a well-diversified core and some carefully selected satellites, you can position yourself for long-term wealth growth while still taking advantage of short-term opportunities. If you like this video, don't forget to hit like, subscribe, and that notification bell for more awesome content on taking control of your financial future. Thanks for watching Blue Spear TV. We'll see you in the next video.